Another great episode of PFREI, a passion for real estate investments. I'm your host, Fuquan Bilal. Today we got a special guest, Mr. Greg Hughes. So, oh man, we run in the same circles in different masterminds, and I really wanted to try to get you on the show to talk about this 1031 exchange thing. So before we get into it, I'll read your bio. So when Greg was only 19, he made his first real estate investment. He bought 3 houses on a half-acre lot, living in one and renting the other 2. After learning the value of the smart investment strategy, he partnered to build several commercial buildings from the ground up, which he still owns and manages today. Now, over the last 10 years, Greg has raised $95 million and has profitably bought and sold 595 single-family residences in 22 states. So we got some experience in the room here, guys. He co-manages 4 alternative investment funds. Now, these funds purchase residential real estate in selected U.S. neighborhoods chosen for long-term stability and profitability. It also has another fund that purchases non-performing notes in bulk at a steep discount. Another fund that purchases homes in single-family market with the rent-to-own strategy, and purchases another fund that purchases reperforming mortgages on a single-family homes. Now, I kind of like that diversified strategy with the notes and the real estate. I do some of that myself, so it seems like your portfolio is well-balanced. And he's also a real estate and investment author and a financial strategist. Now, the first question I always ask my guests is, why are you passionate for real estate investing?
That's interesting. About probably 12 years ago, well, maybe 13 at this point, when it wasn't my business at that point. It was before the recession, right? And I had a buddy of mine who was starting to do first trust deeds. And what I found was, so I joined him. I joined him for a little bit of time till 2009. So this is like 2007 to 2009. And what I found is I've always loved real estate, but I've also always loved the finance side of business. And when you kind of put those things together, they go together. You know what I'm saying? I mean, you can't just do real estate. I mean, I guess you sort of can, but you got to put the finance part together with that as well. And before him and I parted ways, I helped him put together a fund. And it was the first fund, I'd ever done, and he had too. And so we ended up parting ways, and this was right during the recession. And so that's when I started my first fund. And that's what I've learned, that I've just been able to kind of combine those two things together. Way back when I was just 15 years old, I started a lawn and landscape company that I ended up running for 19 years. And during that period of time, in fact, those 3 homes that I bought as a young guy, I ran the business out of there, and then I sold those, and I actually lived in one, rented the other 2 out, and sold those. And then I bought some land and built a commercial building. And so all along, I've been doing something along those lines of real estate. And I will tell you, when I bought the commercial building and I kind of ran the numbers on that, I said, geez, I only need like 1 more of these, maybe 2 of them, and I can retire. I mean, this is a retirement, and especially because I had the business in there, right? Business is paying me the lease payment for it and everything. And, easier said than done. I do own 2 commercial buildings today. Still have the one that I built. And we actually run our company out of it as well. So, but I don't know. I just always have really enjoyed that. I used to have kind of a passion for the stock market, but as I have learned over the years, there's just no control with that. I mean, you do what the stock market does, right? And with real estate, there's just so much more to it, and there's so much more safety, and and it's obviously tangible, and it's just something you can control so much more.
Yeah, so, stock is definitely a zero-sum game. I had another guest on it earlier, and we were talking about that is no control. The alternative investments is really the best way to go if you want to see a better yield. So when you actually started to get involved with it, get your first property, and see the power of it, now it's actually like you're out there serving the community, helping investors generate some passive income. So how was that transition from being a property owner to a fund manager? Because it seems like, over a significant amount of time, you built these funds out to buy notes, to buy properties. 600 properties is a lot of properties, a lot of work. So
Yeah.
let's talk about that transition from a property owner on that investment side of owning a single asset or multiple assets, then transition into a fund manager, because that's a whole nother business.
It's a whole nother business. And just to kind of go on that same thread that I started with, is when I owned those first 3 homes, the one I lived in and rented the other 2 out, I have all the typical stories of having tenants, right? I mean, once I was trying to collect the rent, I got punched. One time I came out of my house, I noticed a guy ran a telephone line from his house to my house to hook into my telephone line, So I'm like, what? You think I'm not going to notice this or what, right? So then I go build that commercial building that we put the lawn and landscape business in. And I think I died and gone to heaven because, really it's a triple net lease because I had other places that I leased out in there as well. And so I thought, really, that's the way to go. And so I really kind of, after that, said, I really don't want to ever own another single family home. And so because the commercial was a much easier way to go. And it still really pretty much could be, but it's not as safe either, And so as we've gone through all that period of time, one of the things that happened was when my partner and I got together about 11 years ago, is we were both part of putting money in those first trust deeds. And that was back when times were crazy, right? Real estate could never go down. And mainly all those first trust deeds were on vacant land. So, well, what happens with vacant land when everything, goes down in the economy? And of course, it's maybe the worst we've ever seen, right? So you have no income coming in. It's all expenses, everything like that. And so as we transitioned along, as we started to build the funds and do that, and our very first one, which was more based on lease to owns, we always kept all of our homes in the core rental market, because we always say, what's the thing that's going to hurt us the most, right? I mean, during the downturn, what happens to us? Well, worst case scenario is a lease to home homeowners or tenants, whatever you want to call them, can't end up buying the home, but we have a home in the core rental market. And therefore, if worst thing we had to do, we don't have to do a fire sale, we can just rent the properties out and sit on them. And we knew we'd have cash flow, maybe it'd be break even, but much better than having to take, a big hit and lose a lot of money with that. So as we transitioned, and this kind of an interesting way that it's all happened, the lease to owns were great because the tenants were really in charge. It was like a triple net lease to homeowners, not a homeowner yet, but we were very picky about who we brought in and did all that. As we transitioned and we started buying a lot of homes, what I'd say more affordable, smaller homes in the Midwest, we tried to do the same deal, and we just couldn't find enough qualified people to do it. So as we started keep looking at it, and it kind of evolves, because all these things evolve all the time. We said, the best way to go this direction is to turn to rental homes. And at that point, when we kind of looked at it and we said all that, my partner looked at me and says, if we do that, I'm out of here. I'm not having a bunch of rental homes in the Midwest that we got to take care of. Let's just, we'll work it through and see how it goes. Now today, we have, as the time you and I are talking right now, about 477 doors in the Midwest that we manage on that. And so now we do have some of those set up as lease to owns, but the majority are not. They're really just a buy and hold for us. And we just love being in that section of the real estate. We love the part of we're in affordable homes. These homes don't go up and down in value much, so we're not real worried about when we're buying them. Or we don't plan to sell them. If something turns down in the economy, we don't really care. We don't even care if the homes are worth less. We're just going to collect the rents. And the whole thing we've done is built it all on cash flow. No appreciation, because there really isn't a lot of appreciation with most of those homes anyways. You get a little bit, but it's not a lot. And all we care about is making that, getting that rent and having the cash flow. So all along, you just kind of evolve as those things happen. So that's, I know, kind of a long answer probably to your question, but it's better that than you having to I give you a one or two word answer. Well,
Yeah.
what's my next question?
Yeah, because a lot of people, they see me and where I come from, and other people like you who transition from just owning property to actually owning a vehicle that actually can buy pools of this stuff and raise capital and everything else. And they just think it's a walk in the park. It's a lot of work, a lot of regulation, a lot of different things you have to go through to consistently manage it successfully. There's a lot of moving parts, managing vendors, contractors, and everything else. So just trying to get the people to understand who may watch this. It's definitely possible, but be prepared to roll up your sleeves and really get busy. Now, let's talk about the biggest challenge that you face. I mean, for me, it was scalability. Every time I wanted to grow to the next level, I always had to face that situation on process mapping and trying to make sure that I'm growing with the dollars that I'm raising and the capital that I'm deploying, right? It's another issue most fund managers have. If somebody writes you a check for $10 million, you have to be able to deploy it efficiently and be able to scale with that. So that was one of my biggest challenges that I had to overcome. What are some of the biggest challenges over your real estate career that you had to overcome that you've learned from?
Yeah, probably the biggest thing, especially with our buy and hold fund today that buys all the homes in the Midwest, is, we live in Reno, Nevada, so we're 1,500 miles, maybe 2,000 miles away, where we buy in St. Louis and Cleveland and Memphis and Birmingham are our main places that we buy. Um, all the same pain that always comes along with all that stuff. As when we started, we weren't big enough to have our own property managers and own construction people, all that sort of stuff. And so, yeah, we had to have third-party property managers, and I don't care how you slice it, how hard you work at getting those people to try to do a good job for you. It rarely happens, and it's always a challenge. So as we hit, probably is around about maybe 250 to 300 doors, we started to hit enough economies of scale that we actually started hiring people in the Midwest that became full-time employees of ours. We have a brokerage, a real estate brokerage in St. Louis and one in Cleveland now. So as we will start to bring on more real estate agents, which will help out with all that. We brought on construction managers, one that works out of Reno. There's one that works out of Cleveland. There's one out of St. Louis, and that are all full-time employees. They're part of our team now. And yeah, there is a lot of things that go wrong and a lot of hard knocks. There's just no doubt. And even still today, I mean, it is still a lot of work. I mean, if somebody were to say to me, hey, I would really love to go own some, let's say they live in California or Nevada, someplace, it doesn't matter, anywhere that's further away from the Midwest. I'd really love to own a bunch of homes back there, and manage them myself or manage them with somebody else. I'd say, wow, I just wouldn't recommend it. It's just too hard. There's just too many things that go wrong with that. And that's pretty much the way we've set up our deal, so that either people can come into the fund, or as we may talk about the 1031 exchanges, all those are still managed by us. And so the people that do stuff with us don't have to ever worry about any of that. There's no anything that they have to mess with, because it's just too hard. If you own 2 to 10 houses, I think it'd be not a smart thing to do, from that standpoint. So
yeah,
some people like to be active on that. So
yeah,
you can't always say, I mean, some people can make it work, but yeah. We all know.
To be more efficient, you really have to have the power team in place or be local, really, to get the best advantage out of it. But you mentioned the 1031 exchanging, because that's one of your specialties, and I want to talk about that. You basically help solve problems so that landlords have no more hassles and double their income, or better, maintain the real estate as part of their portfolio. So let's talk about that strategy that you're using, because I know the last time we was at the last mastermind, you started to give me some ideas about that, about what you guys were doing in the fund and how that was helping out a lot of investors, get a place in a fund or really find value in something they didn't know they had. So let's talk about that.
Yeah, it has been really a fantastic deal. We've been doing this now we're probably about a year and a half, maybe 2 years into it, but I don't think we're quite that. We've worked really hard at trying how to set this up and make it work. And And again, like everything, it's evolved along the way, and now we've got it pretty well, I think, dialed in on the whole deal. What happens is, if you just take a normal situation, somebody's bought let's call it a rental home. They bought it 25 years ago. They paid $200,000 for it. It's worth, $500,000 today. Okay. So they've done well. They've made some money on it, but they've been there, done that. They are done having to be the landlord of that and mess with it. They've reached that point in their life. They're kind of wanting to be out of that. But they also don't want to pay any taxes, because you got to recapture all your depreciation. You'll have your capital gains, right? So if you do a 1031 exchange, you can avoid that. You just take the money and put it into a 1031 exchange account, and then you exchange it for some other properties. Well, that's all fine and dandy, but if you're going to do that, you end up buying other investment property that you have to manage with that. So what we've set up is somebody, let's just take that $500,000 home. They sell that home, put it in 1031 exchange. We can help them do that. And then they come in and we sell them X amount of homes in the Midwest that will be titled in their name, so it meets the 1031 requirements. And then what we do is we master lease those properties back from them. And in the case of today, because this could adjust, but we master lease them back at 8.5% of whatever equity they have. So they have a fixed rent with their what they put in as equity and with those homes. So every month we're going to send them that rent, and we then take care of everything except the insurance. The only thing they're required to take care of is the insurance on the property. So what that means is, even if the hot water heater breaks, we go take care of it. We spend our own money and we do it. If the roof needs to be fixed, anything, it doesn't matter if it's even vacant, it doesn't matter. We got to pay them because we master leased it back. From our standpoint, we put those properties basically back into our portfolio. So now it sits in there as one of the 477 doors that we're managing. And that's how we manage it all through that. And what we're finding is the people that are doing these, going back to that $500,000, there's a pretty good chance they have the house paid off. And so they got all that equity tied up in the house. And we all know the best way to do that is, you leverage it and go buy more. Well, again, they don't want to do something like that. So now they get to bring the $500,000 over to us, and they start to make that full 8.5% on the whole $500,000. Whereas before, they might have had good cash flow, but they don't have a good return, right? They might be making 1 to 4% on their money with that. And so that's where we find it's pretty normal to at least double, if not way more, increase their income. Gets rid of all their landlord hassles, and they're pretty happy with that. And then we add one more little twist to that I think is really important, because for investors, the big question is always, okay, but how do I get my money out? Well, what we do with them is we say, look, we'll just buy your house back from you for whatever we sold them to you for. And that's the way you can redeem your money back out of there. You could actually go do another 1031 exchange. You could pay the taxes or do whatever, but you can do that. And we ask for a 90-day notice. So it makes it semi-liquid, with that, and puts them in a great position. So that's the way it all works.
That's a great strategy, man. That's a genius. Because it works on both ends. I mean, I'm pretty sure it's a nice arbitrage on the end for you guys, taking over that property and making sure that the rents are, it's worth it to pay out that 8%, along with the costs that you have associated with that. You get to add another piece of the property to the portfolio to make the portfolio look good on the balance sheet. So, it kind of works on both ends. That's genius. I don't know why I didn't think of that. You beat me to it.
Well, everybody knows.
But I was laughing.
It's so easy, everybody. Yeah. I really appreciate that, and you saying that, because it's taken a lot of work, and we've thought about this for a long time and really worked on it in the last few years to get to where we are. And sometimes it's funny how things evolve, and they really do become sort of simple in the end, right? The good ones do.
Yeah.
With all that. But yeah, it works out really well.
Yeah, I was laughing actually the last time that we spoke, and I walked away. I was laughing. I was like, because you came to me, I was like, what is it that you do? It was like, I was like, did you see me over here? See me over there? Everything is real estate related. You know, you're doing
Right.
some of the same stuff. You're doing rentals, you're doing notes, you're doing buy and
Yes.
hold, you're selling stuff. So I kind of looked at that and actually trademarked this diversified hybrid real estate investing. And to me, that's
Ah.
a strategy that
Uh-huh.
you diversify across all boards. So if the
Yeah.
market goes down 20% and the banks are selling more notes, you have those that set up already to work those note assets. You have some seller finance going on, you're buying some performing notes, just keeping that cash flow and those cash injections, so you're not just doing wholesaling or rentals only or fix and flip. So I think it's important, especially just like you have set up in these different vehicles, these different strategies that kind of balance off what you're doing. So what keeps you up at night? How do you keep the sanity? Like, it's a lot of stuff going, it's a lot of work. I kind of know what you go through, and I'm
Yeah.
excited about it. I'm passionate about real estate, but I do have my days. But we talked about some of your challenges, and what are you looking for now as we go into the 2020? We just left a mastermind, and the whole thing was the big shift in 2020.
Hmm.
What are some of the things that you're putting in place for your company, to kind of ride the waves or whatever is to come? And then, what's the value add going back to? Are you, doing any education, helping people get, learn about this stuff? So the first question is, what are you doing for 2020? Projecting the market, where it's going to go, that's going to be a transitional play for your company. And then what are you doing to kind of add value to others down the line? Is the second question.
Yeah. So, well, for the most part of what we're looking to do is, and this fund this fund started about 3 years ago, the buy and hold fund. Um, it's truly going to be our first fund that really has what we think is really, really long legs. When people ask me, okay, so what are you going to do with this? I'm saying, well, I think we're going to have it for 20, 30 years. I mean, we just have no intention of turning around and selling any of these properties. Now, that doesn't mean that something doesn't happen down the line. That, of course, that changes. But for the most part, why would we get rid of these things? They're just cash flow, little machines, right? Type of a deal. And especially as we continue to build, as we can hit maybe 1,000 doors and then 2,000 doors, I think things get even better for us. From our standpoint, this year we've literally expanded from about 15 people to about 35. So it's been a really big year. Those are things that keep me up at night, and trying to work through all that. We're working through the systems and everything that we have for our business, and again having to make sure that they are all staying up and scaling along with us with that. So just as well as I do, and you just got done saying it, all the cycles that real estate goes through. So when we started the lease to own fund, we knew lease to owns were going to basically come to an end, at least in the way we were doing them. And they did, because we came out of the recession and homes became more expensive, so lease to owns became more expensive, et cetera, et cetera. And so it's always been that what's kind of next. I see what we're doing today is being next for a long time, but I don't know for sure. But because of, again, we're not buying in California where the prices of the homes can fluctuate by 50%. We're just not in that ball game anymore. Well, and we had the same thing here in Nevada, right? I mean, in Reno and Las Vegas, we had things that went down 50, 60%. So that's what we're seeing. We feel like we're really well set up for a recession when the time comes. So maybe that doesn't change a whole lot for us. And maybe if anything, it makes it easier to buy at that time. I'm not really sure, because I can't, tell you for sure on that. But as for your question on value add, we don't do anything from the standpoint of teaching others. We've just never gotten into that. It's just not been a piece of our business that we've, offered or anything like that. I mean, we certainly love being in part of any of the masterminds and sharing whatever we know. I know we're going to have one coming up here in January, that, so it'll be interesting to hear what others have to say and all that sort of stuff. So, but I just don't have anything great from the standpoint of being able to tell you that there's, we try to do newsletters every month. We do an email that goes out every Saturday. A lot
Yeah,
of those are cheap.
that's what I'm talking about. Those value
Yeah,
adds. I know you used to
yeah,
do. I used to see you a lot. And you probably still do a lot of events where you will go out and speak to people and
we
educate
do.
people on the strategy and stuff. So that's the value add that I'm talking
We
about. I
do.
know you're
We do.
actively out
Yeah,
there
yeah,
spreading the word and sharing the strategy that you're doing and teaching other people how they can get involved.
yeah.
Whether it's passively or you're sharing the strategies you're doing actively, and they may want to do them themselves. So I know you're out there doing that. So.
Yeah, and I do a lot of that with our individual investors as such, and I get to share all the stuff that I learned from you guys. I mean, it's great. It is awesome.
I know.
So I mean, I am
Come
so
back
much
to
smarter today than I was 10 years ago. There's no doubt. Yeah.
Yeah, I mean, the circle of influence is important. It helps you grow to the next level. And at first, I was the one who would say, "Oh, I would never pay to be a part of a group," or I was just ignorant to it until I
Mhm.
started to get in the room with people that was on a higher level, and I was like, "Wow, this stuff is useful," and I
Yeah.
feel, like I'm growing. So just from coming from one session is like, oh man, you have like 15 things you want to really put into action, but you focus on the 2 or 3 that you can actually do, and then
Yep.
work the rest in. But yeah, I thank you, man, for coming on a show and really sharing. You're adding value with this content that you just gave. So,
Sure.
I really thank you for that. It's a passion for real estate investments. Catch us on YouTube, Twitter, and also Instagram. Greg Hughes. I just want to plug your site they can go to. Hughes Capital. That's HUGES Capital.com. You find out more information there if you're looking for passive investment strategies or more information on these different asset classes that Greg is in. Oh man, Turkey Day is coming up.
It is.
So look out for that. And I definitely appreciate you coming on the show.
Thanks for having me, Fukan. It's always a lot of fun.